Earning more with leverage. Welcome to the third lesson of the Forex Basics course. In this lesson, you will learn how to use leverage and earn 500 times more than with your regular investments, what a margin is, and why a margin call and stop out are not the things you'd like to experience, how to calculate your equity and why it is so important. How to use leverage. During the last decade, there have been several major economic events that had a massive impact on the Forex market. For instance, a surprise move of the SMB in January 2015, which was later named Frankogeddon, caused the Swiss franc to soar by around 30% in value against the euro within minutes. In October 2016, the pound sterling dropped 9% against the US dollar within seconds in overnight trading. The incident was described as a flash crash. Such events allow traders to achieve large revenues in a short period of time, but usually currency quotes tend to change in a very small percentage. To earn a tangible amount on Forex, you might have to invest a huge amount of your personal funds and ignore all the rules of risk management and wait for a next major economic event. Luckily, there is a leverage that your broker is ready to offer you anytime you open an order. Leverage is a loan that multiplies your initial investment. Your broker provides you with it at the moment you open your order. Leverage is expressed in ratios. If the leverage is 1 to 2, it means you can hold a position twice bigger than your initial investment. The leverage 1 to 100 allows to open positions 100 bigger. OctaFX offers a wide range of leverage, so you can set it up 1 to 500 depending on your skills and assets you're trading. This example shows how leverage can help you make money. Assume you have $2,000 on your trading balance and you wish to invest it in US dollars, Japanese yen without leverage. That enables you to trade 2 micro lots of the pair. You can open a buy order at the price of 110.872 and hold the trade for about 37 hours until you close it at 112.482. During that time, the price has increased by 161 pips. The price of a pip in this case is 18 cents. This way, you've earned $28.98. To gain a profit of 1.5% of your initial investment is reasonable for such a short time. But let's see what you can gain from this trade using 1 to 50 leverage. Your $2,000 allow you to hold $100,000 of capital. That enables you to trade a full lot of US dollar, Japanese yen. Each pip in the pair is now $9.09 worth. If you make 161 pips, you earn $1,463. You therefore increase your balance by 75%, lifting it to $3,463. You can only achieve such an impressive outcome on the Forex market if you apply leverage. However, do not forget about risks. If you lose 161 pips in your US dollar Japanese yen trade, you lose $1,463 and your balance drops to $537. Using high levels of leverage, you can quickly double your trading account balance, but you can equally fast run into the opposite result and reduce your trading funds to zero. That is why you should not invest a substantial part of your balance into one trade, no matter how much you could potentially earn. In the trading world, you often hear that leverage is a double-edged sword. Proper distribution of funds on your balance is called a risk management, and you will learn about it in our next lessons. Margin and margin call. To offer you a leverage, your broker needs to be sure that you're capable to cover a potential loss of the trade. Margin is an amount of money on your trading account required for opening new positions and keeping initiated trades open. Once you open an order, your broker will control the margin up until you close the order. And if you lose, you never risk the leverage you borrowed, but you risk the margin. That's how it works. Let's take a look at how the margin requirement is calculated. Remember when we opened a one-lot size order with a 1 to 50 leverage, the margin equaled $2,000, which was all the money we had on our balance. Hence, we could not open new orders until we closed this one. But if we trade one mini-lot, $10,000 with 1 to 50 leverage, then to control trades of such volume, we only need $200. This way, we'll be able to use the leftover of $1,800 for further trading. Leverage is expressed as a ratio, and the margin is expressed in percentage terms. If you set the leverage at 1 to 50, the margin amounts to 2% of the order volume. While if you set the leverage at 1 to 100, the margin amounts to 1% of the order volume. Like the leverage ratios, margin requirements vary depending on different currency pairs. Equity. Let's assume you decide to trade mini and micro lots and opened many orders. Good, some of them seem to go in your favor, and you can lock in that profit if you close these orders right now. However, some of your deals are potentially bringing you losses. If you look at your balance, you will see it still equals $2,000, as it will not change until you close all your opened orders. But how can you track the potential outcome of your opened positions? To track the outcome of your trades altogether, you need to monitor your account equity. Account equity includes your account balance and floating profit or loss that your open positions have occurred. Let's see what you've got. It looks like you've picked a strategy that works well for you, and your profit from winning orders is bigger than expenses from your lost deals. Always track your equity and margin level. Margin level shows whether your equity is enough to support your open orders. If your equity becomes less than a margin required for all opened orders, you will get a margin call. Whenever you open a new order, make sure your margin level is 500% or higher. It is a good practice to keep your margin level at around 1000%. In this case, you'll be able to maintain the order open if the market temporarily goes against your prediction. You'll be able to wait for the market trend to alter and avoid closing a losing trade. You approach the danger zone if your margin level goes below 100%. The margin call is triggered when your margin level hits 25%, just before your account balance drops below the point where it is unable to cover your potential loss. Once it happens, you need either to top up your account balance to increase the equity, or close the position and fix the loss. If you do not increase your balance after the margin call, stop out will be triggered at 15% margin level and your orders will be closed automatically. This way your broker protects you from the potential losses that you cannot cover with your own investments. OctaFX uses balance protection so you cannot lose more than your initial deposit, even when trading a highly volatile market. Here is a real example of margin call and stop out in action. Minus $17.60 will not be charged from the trader due to negative balance protection. Using the trading calculator on OctaFX, you can learn what margin is recommended for the currency pairs and leverage ratio of your choice. It also shows the pip value for each currency pair. For example, if you're trading one full-size lot in Euro-US dollars using 1 to 50 leverage, your required margin is $2,319.18. In the case of Euro-US dollars, the calculator shows the value of a pip on a full-size lot of Euro-US dollar, which is $10. Summary. Leverage allows you to trade several times larger volumes than you could with your initial deposit. It can multiply your profits, but it also multiplies your risks. Leverage is expressed in ratios. A margin is a deposit required to maintain your orders open with a leverage. Margin covers potential losses of your trade to a broker. A margin call is a notice from your broker triggered when your losses are about to become bigger than your margin. When you get a margin call, you should either close your trade with a loss or add extra funds to your account to enlarge your margin. Stop out is an automatic close of your trade when your losses become equal to your margin. It protects your account from going negative. In the next lesson, you will learn how to read the candlestick chart and what time frames to choose for trading.